everybody talks a big game when it comes to asset management and their ability to execute better than everybody else and the team they have behind them. And that does play a big factor. And there are groups that have, superior, advantages in their marketplace and superior teams versus their competition. But you really can't fight the macro. I think there's a lot of people that got super lucky, 10 years ago, they got into space and caught that upcycle. And then there's some people that got in a little too late and got really unlucky. And I don't know if there's a big difference between their mindsets and their ability to be good operators necessarily at where they were. I think timing matters, I guess is what I'm trying to say. Where they were in their growth phase. They just happened to get in at the right time, or they happened to get in at the wrong time.
So Paul, you've been an active investor, you've been a passive investor, you've been on like both sides of the equation so far. Throughout your journey, like what do you think has helped you be on either side of that process, being an active and passive investor? Like what has helped you most?
That's a great question. Really firing right away at me, Justin. I appreciate that. I think, being a passive investor has a lot of advantages. From a diversification standpoint, you can get into different asset classes, different geographies, leverage different sponsors, expertise and skill sets, and kind of round out your portfolio. If I were to just invest actively and kind of exploit my unfair advantage, it would be in this local market in residential real estate. And while it does provide diversification away from traditional markets like stocks and bonds, it doesn't necessarily offer that much diversification from a real estate perspective. So I've enjoyed being a limited partner in that capacity. And I think how it's helped me be a better active investor, number one, is probably empathy. I understand what it's like to wire a check after I've done my due diligence and basically at that point have no control over the outcome. I trust the sponsor as much as I can at that point. I like the deal and all the, forecasts and metrics and the business plan built around it. But at that point, I'm not in control as a limited partner. So as an active investor, when I ask other investors for their capital to invest in my deals, that's something that I take very seriously as a fiduciary of their capital, because I've been in situations as a limited partner where I've been disappointed with communication from sponsors. I've been involved in some deals where there's been fraud. I've been involved in deals where there's been total loss. So that changes your perspective, I think. And I think a lot of people that are active in the space that are raising capital from investors, hear the mantra that it's other people's money, leverage other people's money. Well, it's also their livelihood and it's their hard work that they've spent years building up. It's their college kids' tuition or the kids' college tuition. It's their vacation money. It's their, equity in their homes. It's their retirement. So I take that very, very seriously. From an active standpoint, when I'm evaluating passive investments, that's been a game changer for me as well, because I really understand the underwriting. I understand how to get into the file, stress test the assumptions, kind of know when the pro forma is built around, rainbows and roses, so to speak, when everything has to come true and everything has to go right for the business plan to come to fruition. So I look at it with a much more critical eye, I would say. So they really complement one another. And I think it's been a great experience for me to have kind of both in my bag.
Yeah, that's a great answer. Kind of like what pops in my head is like when I was on the banking side, I kind of got to see commercial real estate and multifamily loans from a different lens. And so now I think that's kind of helped me being on the investor side, kind of knowing what banks look for, how they evaluate sponsors, how they underwrite deals. So kind of like, similar situation, but being on both sides of the equation in a similar front.
100%. That's another, a great complementary skill set to have in this space, and one that I think would really be a benefit. So kudos to you for having that.
So what's one thing you think that is going on right now in the market that is overrated, not talked about enough, or something that's just not working right now in the current market?
I'd say value add multifamily real estate is not really working, as it has over the last decade or so. I think there's still a lot of price discovery to happen. If you think about where we were a couple of years ago at the market peak, in most metro areas, A class, B class, C class properties, as far as where their cap rates were and where they were trading at, were almost on top of each other. Maybe there was a 50 basis point spread. So if an A class property was trading at a 3 cap in Florida, imagine that. A C class property might trade for a 3.5 or a 4. So I think, Traditionally there's a bit more of a risk premium tied to those older vintage properties where investors demand a little bit more of a return to take on that additional risk. That went away for a while. I still think that there's more room for those B and C class properties to blow out a little bit more on the cap rate expansion. So I'm still seeing pro formas built around, the assumptions that I mentioned before that are a bit too aggressive, probably cap rates that are too compressed at exit, rent growth that's still a little too aggressive. I like to look at kind of averages from a historical standpoint over like a 20-year horizon. Like, what does it look like there? If rent growth is 2% over that period, and they've built in that into their model, well, that's probably a realistic scenario. But if rent growth has been 2.5%, and they've got 5% rent growth built in over the next few years, like I've seen recently in a real life example, that's probably not likely to happen. It did happen in 2020, 2021, but it's not likely to continue. So those types of things, I think, are still happening in underwriting, and I think there's potentially some downward pressure on the tenant bases in those types of assets as well, where rents have risen so quickly. Wages have come up quite a bit, but a lot of those wages have been in white collar jobs, whereas some of the blue collar jobs haven't kept up as much. And now you've got talks of a recession. You've got increased input costs. Operators are facing increased insurance costs, increased taxes, et cetera, et cetera. So they want to, as operators, continue to push those rents up. But can the tenants in those markets and those types of assets afford those rent increases much longer? I don't know. So I think value add, I say it's dead, but it's not dead. There's price discovery that still needs to happen. It'll come back around. It's just not a space where I'm as excited to play in as I was, let's say, 4 or 5 years ago. So I think you can still find some yield and some attractive upside and some assets that are really banged up. The heavy lifts that have a lot of meat on the bone and a lot of yield on cost. Um, so there's still room there. But putting in a dog park or raising rents by $100 after you redo the clubhouse, that kind of stuff is just not as appealing from a business plan perspective. The newer stuff that's in growing markets that you can get well below replacement costs with positive leverage, fixed rate debt. You can expect probably longer holds and lower returns, but I think those are safer plays in today's market.
So you mentioned price discovery, so meaning kind of like going off what you just said, but there's not enough upside or margin to make these deals pencil out like in the current market conditions. It just doesn't pencil out
I
based on
mean,
the
it could
risk you're
pencil.
taking
It could pencil, right?
at the right
Based on
price.
yeah, at the right price, it pencils. But the price that buyers are paying today, they have to push that pro forma pretty hard. And some of those assumptions are what's at stake as far as is this going to come true or not. And if one or two of them don't, that's where that exit doesn't look so strong. And many of these assumptions or these pro formas that these operators have built, are not very durable, let's say. So if one or two things goes wrong, that puts a lot of pressure on the equity in the deal and the potential for, being able to refinance or having a plan B, let's say, in a lot of cases isn't there. So just having multiple exit strategies, having a flexible business plan, having adequate reserves, and trying to stay too far away from stuff that's going to get you in trouble, I think is the best road right now.
So you mentioned a couple of things there about looking for reserves, margin for error. Are there any metrics that come to your head that a passive investor could quickly glance at in a pro forma and view like, does the deal have margin? Is it too skinny? Or is there a buffer like in these numbers? What sort of like metrics can they look for to see is this a good safe deal?
Yeah. Well, I tell you what they shouldn't be looking at, and that's IRR, right? Because that's everybody gets excited about IRR, but IRR is really an output, and you have to focus more on the inputs. So, if I were a passive investor looking at a deal, what I'm focused on is untrended yield on cost. So I want to know if I buy it at this basis, and then I have a plan. Let's say there's some capex or there's some additional costs that I'm going to incur to execute the business plan. If I add that to the purchase price and then all the costs associated with the transaction, that's my total project cost. If I take that number and I divide it by my stabilized net operating income, what rents are going to be once I execute that business plan, not tomorrow's rents based on 5% rent growth over the next 2 years while I'm executing that plan. What are rents today? And it may be that they're $100 more than the asset I'm considering in that market. I want to find out if that's accurate or not. But if that is the case, and I've got a yield on cost number that's 100, 150 basis points or more than the prevailing market cap rate, then I know that I'm building value by, buying into that sponsor's plan, so to speak. So
Exactly.
I think of it in two ways. One is that, yes, there's actual value being created here. It's not like I'm putting all this money into the project. Or I'm speaking as if I'm the sponsor here, but putting all this money into the project and then, ending up with a yield on cost of, let's say, 6.5 when the market cap is 6.5. That's really, putting a lot of sweat equity into something and not really gaining anything monetarily or value in the asset itself. Same example, if you can have a yield on cost of, let's say, 8% and a market cap rate is 6.5, then you've created that extra value. You've actually driven value into the asset. And that's number one. Number two is it's almost insurance, so to speak, on your principal as an investor. Because if the market cap rate were to expand further, let's say that 6.5 cap example, that market cap rate expands to a 7, but my yield on cost is 8, well, I still have value there. I haven't lost any principal. If that market cap rate goes up to an 8.5 and expands by 200 basis points, then I'm in trouble. But that's a pretty good margin of safety there. And that's insurance on the principal, so to speak.
Yeah, great point. And so just to recap, you said untrended. So this is looking at your yield on your project that you're having today. It kind of cuts out the noise of like any kind of rent growth or any kind of assumptions that would get in the way of those numbers. So untrended kind of just cuts out the actual, the noise of the calculation.
Yeah, you want to base your assumptions as much as you can on reality and as little as you can on crystal ball. And sometimes pro formas go in the trash. I know that day one after the property closes. So, but as much as you can plan ahead and have multiple scenarios and stress test those scenarios, the better off you are.
Yeah, I love that. Okay. Yeah, let's jump into a section called the real deal. I want to ask you about a real deal that you've had either active or on the passive side. And what's like one deal that kind of sticks out to you that you would not mind sharing some details about?
Yeah. The deal that sticks out is the one we just did. We just closed a week ago today on an asset down in the southern part of Indiana, right in the Louisville MSA. It's 9 miles from downtown Louisville.
So still in Indiana, but
Still in Indiana. Yeah. From an active perspective, I only invest in Indiana to date and probably will stick to that just because I feel like I have good relationships here and know the markets that I'm invested in. I can drive to the assets, et cetera, et cetera. But this particular deal was an interesting one because I had just sold a property earlier in 2025, and I've had my funds, the 1031 funds, sitting with a qualified intermediary. And I was looking for, assets that I could operate myself. But today there's just very little hitting the market, as you know. I mean, it's tough to find deals that pencil that are on the market. There's not a lot to choose from. So I was really, had my pencil in hand and I was looking at everything that came across my desk, calling everybody I could. And I ended up getting in touch with another local operator here who had a deal under contract and was looking for capital, a large deal. So I came in as a 1031 via a tenant in common arrangement as one piece of the pie. And then my fund, InvestWise Collective, came in and we raised additional capital as a co-GP. So we were kind of participating. I guess I was participating individually in one regard and then collectively with a couple partners and then all of our passive investors. So it was about a $10 million raise, a pretty big lift, certainly the biggest project I've been involved in as an active investor, and quite complicated. Agency debt, a lot of moving parts, more contracts and paperwork to sign than I've ever seen in my life. But we just executed on it, and now we're looking forward to unfolding the business plan. But it's kind of similar to what I was talking about earlier as far as the type of asset. It's 2023 vintage, new build. There's not a lot of capex to spend. Not a lot of construction materials to buy that would be subject to tariffs or inflation. It was a builder that was kind of caught at the wrong time when they delivered the product and there was oversupply in the market. But now, as in a lot of markets, supply went way up, but then construction kind of stopped when interest rates went up. So supply is really set to fall over the next couple of years. And we think we've got a really nice product in a growing market that we got for well less than replacement cost, what it would cost to build it today. and we got good fixed rate debt, positive leverage, meaning that the interest rate is quite a bit lower than the prevailing cap rate. And the trending financials of the asset going in are looking really good, where we're up in the 6.5 to 7 cap range for the T3. So all those things lead to a pretty safe, I'd say, single or double for me and for our investors, which I think in today's market is really what you're looking for. We're not trying to shoot for 20 IRRs. If I see 20 IRR as a metric as a passive investor, I'm immediately flagging that thing and figuring out why. What did they do to this pro forma to get to that number? Um, so, we're looking to kind of hit it right down the fairway and preserve capital first, and then create some, tax benefits and, hopefully do better than we plan, but not have a lot of downside from where we stand today.
So the fact that this deal was stable, cash flowing, newer vintage, not necessarily a home run. I mean, absolutely, it can be a home run, but you're not necessarily banking on that. But it's more of like a safe, conservative cash flow play for like the longer term. So a combination of like that newer vintage, undersupplied market, and you mentioned the supply drop off happening in the next coming years, which could increase rents substantially and just make your returns like even more higher than that.
Yeah, and we're not underwriting to those massive rent gains that we might see if supply really does fall off and there's still all this demand there. There's certainly some things happening in the market that could lead to that outcome. But we want to be prudent and be conservative
So
and
sort of
be
like under promising over
That's right.
delivering.
That's right.
Got it.
And if it comes to it in 5 years from now and it's not a great time to sell, we think we'll be in a pretty good position to refinance once we, bring rents to where we need to get them. And, assuming that there's not some, black swan type event, which could always happen, we'll be pretty protected. So, those are the kind of deals that I'm attracted to today.
Okay. Awesome. Tell me about the financing on that property. You mentioned fixed rate, agency debt. Like, how was that process working with the lender? Why did you guys choose fixed rate debt? What kind of interest rate did you guys lock in? What's your take on all that?
Sure. So I was a co-GP in this deal. So the lead sponsor kind of helped originate the debt, and we worked with JLL on the deal. They got us involved with Fannie Mae. So, and as a tenant in common on that side of it, as a 1031 transaction, there was quite a bit of back and forth and contracts that needed to be settled and approved by the lender. And the org chart was a little bit more complicated than a traditional transaction, at least from my experience and for where I stood. Um, so that was all part of the experience and the learning and the growth, so to speak. But the deal itself and the terms we got, I think, were fantastic. We got a 5-year note, 30-year AM, 4.96 interest rate. That was with a buy down. In today's market, that's really sound. We hit the 10-year. The 10-year was kind of dropping as we locked the rate, so we hit the timing on it pretty good as far as locking it. But yeah, I mean, agency is really sound for multifamily. It's great to see. Now there's some changes coming potentially. I don't know if you heard in the news recently that the Trump administration might try to to make Fannie and Freddie, the GSEs, private again. So would that change? Anytime there's change, there's always concern. But right now it's the best game in town for stabilized multifamily. And since this product was 90% occupied for 90 days and longer, actually, qualified for agency debt, so we got the best terms we could.
Great. And speaking on financing, going back to your experience being on the active and passive side, what's your take on fixed versus floating rate debt? You've heard a lot of noise about floating rate debt recently. Are all deals with floating rate debt bad? What's your take on fixed versus floating rate debt on deals?
Well, it's the ones that are in my passive investing portfolio are bad. That's for sure. Yeah, and thankfully I didn't get involved too many because I'm pretty adverse to floating rates. It's just one of those variables that if you can take out and sleep better at night, knowing that your debt payment is your debt payment, I think there's something to say about that. I know as well that over the course of time, floating rate debt has traditionally panned out to lead to better returns, right?
Especially in the syndication space when you're flipping properties and you want that flexibility.
Totally, totally. And I can see why there's a lure to using that type of debt. But when things go wrong, typically they go wrong in a big way. So for me, that's enough reason to kind of stay away from it. Fixed rate today is in the, it depends on what kind of debt you're getting. Like I mentioned, we're around 5% for agency debt. If you're getting, recourse debt on multifamily, you're probably in the low sevens, maybe the mid sixes to low sevens is about where it is. If you're looking at other, asset classes, industrial, self-storage, I think it's kind of similar in that range. And it depends on the lender, it depends on the market, it depends on the credit worthiness and the, who the borrower is, and what their track record is. But I think you can make things pencil okay and still have them cash flow many of the assets you can. If you can't do that with fixed rate debt, to me, that's not worth taking on that risk. That's not an asset that I'm attracted to buy. With bridge, you're gonna have a little bit more flexibility. Um, you're gonna have to bring less capital to the deal. So your returns could be higher, assuming that the rates stay flat. And if you hit it right, those rates will go down during the whole period. And of course, that's attractive because your debt service is lower. You're going to have more free cash flow, and that's good. But we really can't predict interest rates. Even the best economists in the world who study interest rates all day long get it wrong most of the time. So for me, that's enough reason, like I said, to stay away. And I prefer to use lower leverage. I don't think I mentioned that when you talked earlier about what we did on that deal and what terms we had. We're at about 65% loan to value. So
Okay,
that
awesome.
gives us some margin as well to kind of absorb potentially, declining values and still be okay and protect most of that equity. So, um, yeah, I mean, overall, it's kind of interesting because some people think that in my family, for example, like, oh, you're investing in real estate, you're taking on debt, you're doing this, that. It's so risky. It's like I might be the least risk on person in the whole space. A lot of people that I talk to are like, dude, you got to do it this way. Like, well, no, I can't do it that way. And I'm just going to have to pass on a lot of deals, I think, because of that mindset. So that's okay though.
Awesome. All right, let's move into some off-market questions. These are questions that I feel like go like under the radar, don't always get asked, but we're gonna like dive right in and ask some practical questions I think listeners want to know about.
Uh-oh. All right, here we go.
So, as a passive investor, assuming you've invested in a variety of different asset classes, how has multifamily performed in those different passive investments compared to other asset classes?
Uh, some good and some bad. Like I said, I've got a couple deals that were floating rate. One was floating agency debt. Uh, a couple were bridge, and one of them looks to be okay. Another one is probably either going to be a refinance with a cash in refinance, or so that'll probably be a capital call unless they have enough cash on hand, which I'm not sure if they do. Or they're going to utilize an additional extension on I think it's the last year of a bridge loan. So um, that wasn't, the plan. Obviously, going in passively, it was to, have a better outcome than that. But I've had plenty of good multifamily deals as well, and I think really where it starts is the sponsor and their ability to execute the business plan and you know um, their mindset around risk. And because I haven't invested a lot in bridge debt, a lot of those deals were fixed rate or they were recourse loans through local banks to that sponsor, where they've got a local relationship and they can go in and they can shake the hand of the lender that they're working with, that kind of stuff. So it's performed okay. And they've all been in areas outside of this area because I wanted that geographical diversification. So I wanted to get into markets where there's a little bit more appreciation and population movement. So areas like North Carolina, Florida, Texas, Arizona. And these are deals that I got into, 2016 through 2019 that performed really well. The stuff that I got into in 2021, 22, not as good, right? So
Is that going back to, not to cut you off, is that going back to like the actual multifamily performance that has been negative, or is that problems with the debt and like the abnormal event interest rate increasing substantially over time, or is that like something to do like the actual property that has made these deals like not perform as expected?
mostly macro factors.
Macro
Yeah.
factors, correct?
Mostly macro
Okay.
factors. Yeah. And I think, everybody talks a big game when it comes to asset management and their ability to execute better than everybody else and the team they have behind them. And that does play a big factor. And there are groups that have, superior, advantages in their marketplace and superior teams versus their competition. But you really can't fight the macro. I think there's a lot of people that got super lucky, 10 years ago, they got into space and caught that upcycle. And then there's some people that got in a little too late and got really unlucky. And I don't know if there's a big difference between their mindsets and their ability um, you know, eh, to be good operators necessarily at where they were. I think timing matters, I guess is what I'm trying to say. Where they were in their growth phase, they just happened to get in at the right time or they happened to get in at the wrong time. And I think that's not said enough in this space is how much luck can play a factor. you know, I think hard work matters. I think networking matters, and who's in your network and who knows you. I think your ability to understand the financial side of things, to manage the manager if you're using third party management or have your own management company, all those things matter a lot. But if the Federal Reserve takes federal funds rate from 0 up to 5%, and you're in the way of that at the wrong time, you're going to have some headwinds, big ones.
No
So,
control over this stuff like that.
right. So I think timing does matter a lot. And how multifamily has performed in my passive portfolio versus other assets. I've had some pretty good success in industrial deals. I've had good success with debt funds that provide solid income that don't really have that upside. Done a couple of deals in self storage that went well. But everybody in real estate has faced the same kind of uh, challenges over the last few years. So I was investing more passively, I'd say 16 to 21. I've done a lot fewer deals on the equity side since 22 and a lot more on the debt side since then, lending private money and doing deals with debt funds. So those have performed pretty well. But everything goes up. Everything that goes up eventually comes down. So
Yeah.
yeah.
All right. So like in your opinion, like what separates the best sponsors from the worst sponsors? Like what do you look for that says, hey, this is a good company to potentially invest with? Like what sort of like sticks out, either good or bad from these sponsors?
Well, some of it is subjective, frankly.
Okay. What do you mean by that?
I'd say, you know, it's hard to read a person until you see them in a pressure cooker and know how they're going to react. And you don't always get that opportunity. But what you want to find is someone who would rather lose their own money than yours if you're a passive investor. Um, that it would bother them so much that they would rather break their own arm than lose, $2 million in investors' capital. And I think that is relatively common, but it's not uncommon at all to find others that are, you know, looking for fees and just trying to acquire as much property as possible and really don't care what happens to their investors. So I think that's first and foremost. Their ethics and secondarily, their ability to execute the plan. Do they have the capability? Do they have the track record, the experience in the market, the relationships to execute that plan? Those two things are paramount, and it all starts with the sponsor. You could put a great deal in front of me. I saw one just this morning that was very, very interesting, but I have no idea who the sponsor is, and they want me to allocate into their deal. And I'm like, let's have a conversation, of course, but it's probably going to take me quite a while, more than you may be willing to spend to get me comfortable enough to invest, especially if it's with other people's capital. Um, so it's always sponsor first and then the deal. And you always have to consider the macro, like we talked about before. But I think people's ethics and they do what they say they're going to do. Do they communicate effectively? And these are all things that you can kind of vet now, I think, better than you used to be able to because the space has grown and there's now pockets and communities of passive investors that talk with one another and share their experiences, good and bad. And if you do your homework enough, you can find somebody who's invested with another sponsor that you're considering and hear about those things. And that word of mouth is really powerful.
So going off of that, you mentioned track record. It's a term that gets thrown around a lot. You might go to somebody's website and they could have $500 million of assets under management. But how do you dig in and make sure that all those assets are performing correctly, performing to their standards and up to their performance numbers? Like, how do you verify those fancy pictures on the website are actually performing well and their investors are well taken care of today?
Mhm. Great question. For those that have big portfolios like that aren't performing well, there's enough of those groups that I mentioned before that there's word of mouth happening right now that everybody kind of knows that's stay away from potentially those guys or what they acquired between 22 and 23 is in real trouble. And sometimes those sponsors are communicating effectively and saying, hey, here's the real deal, here's what's happening in our portfolio, And I have a lot of respect for that. Whether I would have invested or not, maybe my risk tolerance isn't the same as them and their investors. Okay, that's totally fine. And now they have to face the music on some of these poor outcomes. Well, the ones that are stepping up and communicating effectively and saying, hey, here's what happened, here's why we made the decisions, and here's the situation we're in. I think that's a stand up move, and I have no problem with that. It's the ones that don't come clean and don't face the music, I think, that are starting to kind of rip their reputations and shred them and put them in the trash, and they may not have a future in the business. People love a comeback story as long as that person has been honest about the mistakes they've made. Some people are not willing to admit their mistakes, and that's a big mistake if they want to stay in the business. So I forget what your original question was. Now we went off on a tangent there, but
About the track record, but yeah, I think you answered
track
it.
record, yeah, and I think it goes back to what I talked about before about timing. Yeah, somebody's track record could look really good if they bought in 2015 and they stopped in 2020. Everything they bought would be fine, right? They didn't even have to do anything. They could just hold those assets, and the market would have swept them up in the tailwinds, and they would have come out smelling like roses. People that bought a bunch of stuff in 2021 with floating rate debt in 2020 through 2023, their portfolios are in disarray. So, what do I look at from a track record standpoint? Ideally, I would love to see someone who's been through like multiple cycles. But that's not always fair, because 2008 was really the last downturn we have. So that means you have to be in the business for 15 years. I don't always just invest with sponsors that have been in the business for 15 years or longer. But ultimately, when it comes down to it, it's a bet on that person. So as an LP, you take a chance and you try to get to know the sponsor as best you can. You vet them, background checks, talk to other investors. You want to talk to people that have had multiple investments with that sponsor, and a lot of times they're going to give you their best references, right? So you really want to get into some communities where you can connect with other people, and find out their history and their track record with that sponsor, and kind of match it up. But as far as evaluating individual assets, you can ask the sponsor whatever you want. Whether they provide it or not is another story. So you can ask a sponsor, hey, can you provide me a P&L for an asset that you acquired in 2022, and also provide me the original pro forma and underwriting file and offering memorandum that you sent your investors, the pitch deck, and let's compare where things are today versus where you thought they'd be. And can you kind of explain where things went either right or wrong? That's an exercise you can go through if you want to go down that path as a passive investor. If they don't want to provide that information, then maybe that's a red flag and you should just not bother.
I agree. And playing devil's advocate, let's just say that somebody was doing that and they're wanting to invest a small amount, let's say $25,000 into a syndication. What would you say to a GP that says they don't have time or they don't want to go through like all the hassle to send somebody all the information just for a $25,000 investment? What would you say to that?
If that's what they said to me directly, I'd say, well, okay, well, we're not a good fit for one another. I was just at a summit with a bunch of passive investors, and that topic came up about investing small sums and feeling like almost like inadequate as an investor. I mean, $25,000 is not a nominal amount of money for anybody really, but for almost everybody, it's a big chunk of money, right? So it is for me. I know that. So especially if it's with a new person that I haven't invested with before, I'm a big proponent of trying to actually work the minimum down and having a small bite into a deal, and then waiting a year and seeing how it goes. Let's see how the communication is. Let's see how the business plan unfolds. Um, don't not necessarily have to talk to the sponsor in that year, but just to see how they're communicating with their broader investor base. And that's sometimes really revealing, as you know. I mean, there's been deals where I've gotten into that are still okay, as far as I know, but I probably wouldn't invest with that sponsor again. And I'm glad that I only invested the minimum, and that's what's exposed for me, because I just haven't really had an experience where I felt like, okay, I'm ready to take the next step and now actually meet the minimum and do multiple deals. And there's been a couple sponsors where that has happened, where I've invested a little chunk, it's gone fantastic, and I've loved the communication and I've loved the follow up. And then I'll go into a second deal and a third and a fourth. And that's really what you want to find, as a passive investor, is that repeat kind of relationship, where if that deal hits your inbox, that new deal, you're pretty much 80% sure that you're going to get into it, right? And some passive investors will say 100% sure. Whatever the sponsor comes out with, if I have cash available, I'm going to invest with it. I always think that you should underwrite each individual deal just to make sure that your risk tolerance stay aligned, because people do change and risk appetites and theses on the market change. So I still think you should underwrite it, but you really want to have, those core sponsors that you feel like, man, these guys have always performed. I love how they communicate. There's been some challenges, but they've always, stepped up and admitted what was going on. And, I've always gotten my principal returned to me. I've had some upside. Those are the ones that you want to ride with.
So what I'm hearing is that communication is huge. Like it's very, well, I'll just say like it's impossible a deal is going to go 100% perfect. There's always stuff that happens. It's multifamily. The unexpected does happen. But what you're wanting is communication. Like you're wanting to know the good, the bad, the ugly. And when it happens, not like 6 months down the road when it's kick the can down the road and it's too late.
Right. Yeah. I mean, I have a friend who's a passive investor, and if he emails a sponsor and they don't get back to him in 48 hours, he won't invest with them. That's his sort of, checkpoint or whatever you want to call it. And that's a marker for him to see that communication isn't a priority, follow up isn't a priority. And maybe it is, and there might be an excuse that's very valid for why the sponsor doesn't respond quickly. But it's enough for him because the space is so big and he sees enough opportunities to just say, all right, that's a pass. Because if I ignore this and then, I'm involved in this deal and 2 years down the road, I'm not hearing anything, I'll look back and I'll say, "Man, I had that warning flag and I just ignored it."
Wow.
So
That's a great point.
yeah.
Okay. All right, Paul. So we've talked about a lot of things. Let's talk about InvestWise Collective. Tell me more about that fund and what that is exactly.
Yeah, so it's InvestWise Collective is myself and three other partners. We started at three of us. Now there's four. We are all passive investors ourselves. We've invested and allocated into over 100 deals collectively as a group, as passive investors. And it was back in 2022 where I was finding some decent deals in other asset classes, but I was trying to scale into a multifamily, syndication business. And the timing I didn't feel like was right. If you remember back in that period of time, the federal funds rate was zero. Uh, Inflation was around 9%. And Jerome Powell, the Federal Reserve Chairman, prior to that point, beginning of 22, end of 21, around that time, had stated that inflation was transitory. Well, he started to back off that, and it looked as if inflation was a bit more structural. And he started to telegraph that rates were going to rise. So going back to our previous conversation about debt and bridge versus fixed, it looked to me like rates were going to rise significantly. That was going to make bridge loans a lot more expensive to carry. And what was happening in the market is everybody was transacting with bridge debt. It was the only way that deals were getting done because you could get more leverage and get more proceeds. You could pay more. So we underwrote probably 150 deals that year, made offers on 50 and 4 or 5 different markets. And we were coming up short on every single one of them. We were about 80 to 85% of where the broker's guidance was. And we're seeing these deals transact at 100% of guidance or more. So after, doing the same thing over and over again, and defining insanity and expecting a different outcome, trying to jam a square peg through a round hole, we decided to kind of back off. And our pivot was, look, we want to have some deals to deploy our capital into. We can't find any in multifamily. Why don't we try to find some deals in other asset classes that we're investing in with our personal funds passively, and bring together checks from other investors and get better terms from sponsors, or get access to deals that we otherwise wouldn't get access to. Like, for example, one deal that we're in has $1 million minimum investment. I'm not cutting that check, and neither are any of my investors. So that's what we started to do. We created InvestWise Collective as a fund of funds. But we will, kind of take a approach of being agnostic to what position in the capital stack we sit in, what role we play in the deal itself, what asset class we get involved in. So, for example, we just invested as a co-GP equity into the deal I mentioned earlier down in the Louisville MSA. We've invested passively as LPs into a debt fund, for example, for our income investors. We might be lead sponsors on a deal locally here, and take the reins and raise money and bring in other fund of funds, for example. So it's a really flexible approach, and it allows us to keep capital in motion. And what I really like about it is that I'm an entrepreneur, but I'm an investor first. And I think that it's it's difficult to build a business in this space because it's a cyclical market and there's ups and downs. So if you have one specific strategy, let's say value add multifamily real estate, well, you're going to have some great times and there's going to be some strong tailwinds at certain points and you're going to have some momentum. And then other times you're going to get crushed and there's going to be no deals and it's going to be a real challenge to acquire. But real estate broadly is a much bigger nut. So we can deploy strategically into different segments of the market, different assets, different sponsors, et cetera, and keep capital in motion and act more like investors than entrepreneurs. So we're not investment advisors. I want to be clear about that. One guy on my team has an IRA, but he's a registered investment advisor, but we are not under the umbrella of InvestWise Collective. We're just four guys that are looking to deploy capital and do it efficiently and do it away from traditional markets. And we created InvestWise Collective as a way to keep our investors involved. And all of us have to sign off on a deal if we're going to invest in it. And then we allow our investors to join us in the deal to either get better terms because of the aggregate check size being better and the sponsor being willing to essentially pay for that. Or again, getting access to a deal that has a high minimum investment. So
Okay.
it's been a fun ride.
Awesome.
Yeah.
So in simple terms, you describe a fund to fund as sort of like a group investment in itself, many different investors coming together to form a fund and then just writing that one check into the syndication.
Correct.
Okay.
Yep. Yeah, we're a single check, and if we can come today, where equity is a little bit harder to raise, for $1 to $2 million, we call it kind of an awkward check size. It's not institutional capital at $10 million. It's not a family office check for $3 to $5 million, but it's not mom and dad for 50,000 either. So we kind of sit in the middle, and we play a useful part, I think, in the equity that's needed to get deals done. So
I like what you said that, instead of, sitting on the sidelines when maybe value add doesn't work or maybe development doesn't work, like you guys can continue to be investors and stay active because of your diversification and, different kind of deals you're investing in.
that's right. Yeah,
Awesome.
we started in 23, and we did mostly debt deals at that point because we just felt like moving down the capital stack, having the underlying real estate that the sponsor was originating debt on as collateral was safer, especially low leverage and in the senior position. And people were starting to see that their distributions were getting paused. Not a lot of capital calls at that point, like we're seeing more of today, or even worse, foreclosures at that point. But distributions were getting shut down and people were thirsty for income, as was I. And a lot of these debt deals where lenders have kind of tightened up and some have left the space entirely. These debt funds have come in and stepped in and kind of replaced them. And through that, they've been able to offer higher yield in the form of higher interest to the borrowers. And us as investors are enjoying the rewards of that as far as income in our portfolio. So
Awesome.
yeah.
Where can anybody learn more about that?
Debt funds in general, or
InvestWise Collective.
InvestWise. Yeah, you should visit us at investwisecollective.com and sign up for our distribution list. And we try to put out a monthly newsletter that gives our take on the market and what we're seeing. And we've tried to have about 4 to 6 deals a year, but we're learning that that's quite a few deals to come up with. And we're pretty selective. So we look at, at least 100 deals before we find the one that we like. But yeah, it's probably 3 to 4 deals a year that we'll come out with. So
Awesome. Okay.
yeah.
And one other thing, I've been hearing a lot about passive pockets. It's sort of like new in the space, but it kind of goes off what we were talking about earlier about, vetting sponsors, talking about track records, how to know a good sponsor to invest with. Talk to us about passive pockets and why should people use that?
Passive pockets is fantastic. It's the evolution of left field investors, which started back during COVID. The founder, Jim Pfeiffer, and a group of other guys put together a community. It was supposed to be live in Columbus, Ohio, and then obviously during COVID, there was no way to meet in person. So they put it online, and it kind of ballooned into this thing that they could have never imagined. And I've been a friend of Jim's for over a decade, so stayed in touch with him. We've always bounced ideas off one another with passive investing, but he's, I think, appreciated my active investing and the approach and some of the things that have benefited me as a passive investor through my active endeavors. So we stayed in touch. I tried to participate and help the community out where I could. And then eventually they were bought by bigger pockets. Actually, InvestWise Collective, backing up a little bit, was partnered with left field investors. And then we were spun off when bigger pockets acquired passive pockets. So we became autonomous, but it ended up working out really well. I ended up getting into that community and being more involved than I was before. Now the co-host with Jim of the Passive Pockets podcast. But the community in general, what's really important is that it's a group of like-minded people that are all looking to, diversify away from traditional assets. There's varying risk appetites within the group. There's various investments outside of just real estate, things like Colombian coffee farms and ATM machines, and you can invest in vintage cars and all kinds of stuff. I mean, it's really, really interesting what you can invest in these days in private markets. But what I think is most unique and most important about this community or any other community like it is having that network to fall back on. And if you have a question that you don't know the answer to, you have a forum that you can go to and post it. And you can get real feedback from people who have been there that are in the space, a concentrated group of knowledgeable experts, so to speak, who've been around the block. There's people that have had passive investments in hundreds of deals on that site. But I think it's very key to know who the bad actors are in the space or who's had poor outcomes with different sponsors, and that's the place where you can find out. So there's a group or a section of the forum, so to speak, where sponsors can be involved as well and interact with investors. But there's also a back channel that's investor only that sponsors don't have visibility to. So to have that kind of community to lean on and say, hey, I just actually was considering investing personally in a deal myself and reached out to the Passive Pockets community yesterday to find out if anybody has experience investing with a sponsor. And, you'd be surprised at what people say, some good, some bad. But it's all good data points to make a decision when you're thinking about writing a $25,000, $50,000, $100,000 check. So it's been a key community to network with for me, and a huge benefit to my overall experience as an investor.
Okay. So it's an online platform. You can go there and talk to other, passive investors, other people that are in deals like yourself, get opinions on sponsors and deals before you actually wire your funds over.
Yeah. And it's more than that. I mean, there's an education component to it with the podcast. They do, we've actually been doing what's called a deal review series where we'll have sponsors come on to the show, so to speak. And there's a panel of limited partners. Sponsors
Like
will
a Shark Tank in a
present.
way.
It is like a Shark
Awesome.
Tank. Yeah. So they'll present their offering in a consolidated format, assuming that the investors have already kind of watched their webinar. It's really a concise, stripped down version of their offering. And then the experienced LP panel will ask some questions that are a little bit maybe more advanced than they're used to getting from, typical retail or, retail check writer investors. Um, so, we're looking at the PPM, we're reading the operating agreement, we're, going into the weeds a little bit more and asking direct questions. And then after 15, 20 minutes of that, the sponsors leave, and then the LP panel gets a chance to kind of discuss what they heard and what they liked, what they didn't like, would they invest potentially? So there's that component of it. There's a lot of webinars that are hosted on that platform. There's blog articles. So it's a pretty robust community.
Awesome. So passivepockets.com.
Correct. Yeah.
Great. Okay.
Yeah.
What's next for Paul?
Man, I just want to keep doing what I'm doing. I'm having fun. Keeping flexible. It's hard to predict what happens in 5 years, right? It's hard to say what could come about, but I really enjoy analyzing real estate. I really enjoy improving the real estate that we do acquire actively. I enjoy networking and I enjoy investing in other people. So I still want to maintain that active real estate investment and passive real estate investment approach. And as far as building a business around that, I'm just going to kind of let it come as it comes to me. Some people decide that they want to do X and they go right through a brick wall to get there. I'm kind of leaving my options open a little bit more. I want to continue to grow InvestWise Collective and bring investors that want to come alongside us into deals that we're investing in. Yeah, I mean, I could see myself doing this for another 10 years, but eventually I'd like to end up being 100% a passive investor and, having that sort of freedom to have time to do whatever I like to do.
Yeah, that's the life, isn't it?
Yeah, absolutely. So I'm not quite there yet. I still am a little young for that. And my kids are in school. I got 3 kids. So I don't know what I would do all day if I wasn't doing anything except looking at other people's pitch decks. But so I've got a little bit more ambition than that. But at some point, I think all these experiences that I'm having, will lead me to developing a portfolio where I can kind of sustain our lifestyle. And, when I'm in my 50s, that'll be where I'm at, hopefully. So we'll
Awesome.
see. Yeah.
Well, really appreciate you coming on the show. Appreciate you sharing all your insights and knowledge. Is there anywhere else that people can get a hold of you or follow you online? Like, where would you tell people to go?
Yeah, like we checked about or talked about, there's the best way is investwisecollective.com or passivepockets.com. And I'm also pretty active on LinkedIn, so connect with me there.
Okay, so Paul Shannon on LinkedIn.
Yes, sir.
Great.